This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to the AJ Bell Money and Markets podcast. I'm Danni Hewson, and this week joining me is Charlene Young. Hi, Charlene.
Hello, Danni. It's another week where it's been all about President Trump's tariffs, with markets continuing their bounce back and many now leaping over where they were before Liberation Day, thanks to a 90-day deal struck with China.
Here in the UK, the latest jobs data hints that the UK labour market is showing signs of strain, but despite concern, the sun has boosted consumer spend. We'll bring you updates from travel company On the Beach, DIY favourite Wickes, pub chain, Marston's and retail bellwether Next, which is also benefiting from the ongoing troubles at Marks and Spencer.
The Bank of England cut rates last week. We'll look at what's been happening to mortgage and savings rates. And whilst we're talking personal finance, I've been investigating why you might run into a few issues if you need to report capital gains to HMRC for the last tax year.
Dan Coatsworth talks to Emily Barnard from Edinburgh Investment Trust about tariffs on the pharmaceutical sector and where AstraZeneca and GSK stand with weight loss drugs.
And Tom Sieber from Shares Magazine joins us to talk all things Warren Buffett. He's been picking the brains of a couple of fund managers about what they think about his surprise announcement and the man who is hoping to fill his shoes. So plenty to bring you this week. And seeing as the weather is still so great, maybe take an extra long dog walk or perhaps cut the grass again, or maybe even a little run. I'm taking on the AJ Bell 10K this weekend. I need all the good running vibes I can get. With that in mind, Danni, I'm going to come to you first because it has been another week dominated by trade deals and tariff talk. Can we start where we left off last week with the UK-US agreement? Because we knew it was imminent then, but we didn't actually have the details when you and Dan were recording.
Yeah, I know. So much has happened. It feels like that was months ago, but in reality, it's less than a week. It was referred to as a landmark deal. But of course, first, we've got to stress that it is not a full fat trade deal because those take months, if not years, to get over the line. Second, it's still got to be discussed, debated, signed, sealed, and delivered over the next few months. And third, we still get a blanket 10% tariff on most exports that we send over to the United States, which of course weren't there at the start of the year. And as we record this, there are now reports that the deal could sour attempts by the UK to create better relationships with China. But that is the bad news. There are some good things, particularly for the auto sector. Now, tariffs on cars reduced to 10% for a quota. So that's 100,000 cars, which is about what we export currently. So a question there, of course, is might there be further deals to enable growth? Because, of course, when we're talking about exports, we're talking about the economy. We want growth. So if we can only export the number of cars that we have been exporting, where is the opportunity? But we did see share price reaction, particularly Aston Martin Lagonda, now up 20% on where it was before the Liberation Day falls, but still down 22% since the start of the year. Another biggie, of course, is no tariffs on steel and aluminium, though I know certainly a lot of the specialty steel makers, the last time that those tariffs came in, they found that it didn't matter because importers needed to buy that specialty steel anyway. So, there are a few question marks there as well, I think. But we've got no change to the digital services tax yet. I stress yet because clearly there's a lot more to be worked out. No change to food standards, which was really important because the UK wants to do another deal with the EU. But there are still big questions about the film sector and pharmaceuticals. We're going to talk more about that later in the podcast. So I guess it was a win. But the jury's out on whether the US comes out of this better. And I think a lot of people would probably say that, Yeah, they do.
Yeah, I think I caught up with the end of Prime Minister's questions. I mean, we're Wednesday afternoon recording this, and opposition have been describing it as a tiny trade deal. I'm not quite sure how that comes in, but yeah, it's kind of now maybe some skeptical eyes. But the big news has been, of course, this deal between China and the US.
Yeah, it was big news. But again, of course, not a full deal. It's a temporary reprieve, an agreement to keep talking. But in the interim period, the 90-day period, tariffs have been scaled way back. So US tariffs on Chinese goods coming into the US have gone from 145%, which just seems insane, to 30%. And Chinese tariffs on US goods going into China have gone from 125% to 10%. Also, there's been some movements on things like curbs on critical mineral exports. They have been paused by China. China's also paused the ban on Boeing plane deliveries. And on the other side of things, those small parcel import fees, the de minimis loophole, those tariffs have been scaled back as well. And of course, that is really important for the likes of Temu and Shein, which we've spoken about a lot on this podcast, because we had expected that maybe by now we'd see a UK stock market listing, but all of that obviously is on the back burner while these tariff talks are underway. I think one of the big things is that even if the 90-day talks don't actually end in an agreement, what they have said is that the tariffs that go back on will still be substantially lower. But what's really interesting is that you have to wonder about Donald Trump's methodology here, whether or not the art of the deal is actually, some incredible deal making skills on display, or whether he really is shambolic, because a lot of people were looking at the tariffs that were coming on, going off, coming on, and saying, well, this is just causing mayhem, and how do businesses plan? And I think a lot of that is still very much in evidence. But if you'd have said to anyone at the start of the year, look, tariffs of 30% on Chinese goods coming into the United States, is that good? They would have said, absolutely no way. And yet, news of this deal going from 145% to 30%, it was like champagne corks were going off.
I know, and I think actually, yeah, maybe we need to change the words we're using. I said deal. I said deal. Actually, it's just maybe a de-escalation and a bit of a pause, isn't it? It's not really, like you say, the kind of deal makers deal. So yeah, one for me to remember not to maybe celebrate these deals so much. And how have markets reacted? You mentioned champagne corks there.
Yeah, definitely champagne corks have been popping. And it's hard not to use the word deal because, of course, Donald Trump's administration, they're using the word deal all the time. This is a great deal for America. We're signing deals, we're making it happen. There has been a lot of buoyancy in markets. I was taking a look at the S&P 500 because Liberation Day, of course, it suffered its biggest single day decline since 2020, down more than 9%. It was a whole load of coverage on a lot of news outlets that don't normally cover investments, market movements, pensions, and talking to people who were saying, I've just taken a look at my pension, I've lost so much money. Here we are mid-May, and not only has the S&P gone back to where it was before that spectacle on the White House lawn, but it is also now above where it was at the start of the year. So when we talk about market fluctuations and people see these great big declines and they get really worried, and we say, don't panic, markets do this. You see volatility, they go down, they recover. Well, this is exactly the situation that we're in. Now, if you look at the NASDAQ, it's not quite in positive territory for the year, but it is substantially above where it was on the 1st of April. And you've got to remember as well, at the start of the year, we also had that AI shock, didn't we? The dark trace issue, which forced a lot of investors to consider whether or not the amount of money being spent on AI was really necessary. But Nvidia, the AI darling, which had seen, a lot of money wiped off its market cap yesterday, it saw market cap jump back above the $3 trillion mark. So I think it's really important to talk about this. The FTSE 100 still down a touch on where it was on the 1st of April, but it's still up more than 5% since the start of the year. And, this doesn't get mainstream coverage. I think it's really important that we start to shout about the positives. But of course, as we all know, there's no news quite like bad news. And at the moment, there is no shortage of news. So a lot of these market movements have been because of what we've seen. It was already happening as Donald Trump sort of paused for 90 days. Some of the biggest tariffs, we know that we've now got 2 months. I think the clock is ticking for some of the agreements to actually get over the line, not least with the EU. But those China talks really boosted market confidence. And then you had Donald Trump in Saudi Arabia with a host of merry men by his side, securing a $600 billion commitment to invest in the United States from Saudi, plus deals to sell arms and AI services, and a bit of a partridge in a pear tree moment. This is, a visit which is going from country to country. And there are a lot of people who are looking at this and feeling a little bit uncomfortable. But ultimately, Donald Trump said that he was going to make deals to make Americans wealthy again. And he is making those deals.
And getting a new plane, I hear, in the course of things.
And getting a new plane, whether or not he would be allowed to keep it once he leaves office, whether or not he can find some kind of loophole. Let's see. Look, Charlene, let's move off markets just for a second and talk about the UK economy, because Dan gave all of you pod listeners a brief update last week, straight after the Bank of England announced that it was cutting interest rates. But I think it's worth just recapping.
Yeah, absolutely. So, as we know now, the Monetary Policy Committee voted to cut the base rate to 4.25%. But it was a kind of proper splitter of a vote, with 2 members wanting to cut further to 4% and another 2 voting to actually keep rates on hold. So, I think that shows, even those in charge of monetary policy are not in agreement with the best way how to deal with, I think, what I will describe as the global roller coaster it feels like we're all riding on right now. And I know we said we step off markets, but I absolutely echo that sentiment that you said about, and we talk about, we always see billions, trillions wiped off stock markets, wiped off people's pensions, but we never see the headlines about it being wiped back on again. And I know that's a pet peeve of some of the financial advisor community that I know, where people are checking stuff when markets are falling, when they might see falls or red against their holdings, but actually, we're all guilty maybe of not checking when things are back on the way up. So why was there an interest rate cut this time around? Well, lower than expected inflation played the kind of biggest role. And even though inflation is expected to tick up in coming months in the near term, it's not going to be by quite as much as the Bank of England thought earlier in the year. So right now they're expecting CPI inflation, the Consumer Prices Index, to peak at 3.5% later this year, rather than the 3.75 they were forecasting previously. Of course, these are still only forecasts. And within those forecasts, there are also some grave concerns about economic growth. So something Rachel Reeves will not be pleased to hear, and concerns about the jobs market, and in particular unemployment, that we'll talk about shortly.
Yeah, I mean, the economic growth thing's interesting because we're going to get GDP figures tomorrow, I believe. And I'm sure we'll talk about it on the podcast. But again, the outlook for growth didn't look quite as bad as it had previously. And certainly GDP, again, we talk about bad news, but we don't talk about the good news. Things are looking a little bit better. But we are still expecting further rate cuts over the course of the year. And some of it is down to that expectation, and some of it is down to the cut we've just have. But are we seeing an impact on our personal finances?
Yeah, and like you say, we saw the split vote of the MPC, and some people were forecasting maybe another 2 or 3 cuts by the end of the calendar year to interest rates. Other people, saying, hold on a minute, that might be a little bit hasty. So I'll start with savings first. So you probably started getting emails about rate cuts on your savings. I certainly have. And it does look like many of those kind of fixed cash ISA rates. So, the rate that you get if you agree to lock away your savings for perhaps a year or two are also on their way down as well. I mean, there's still a couple of really good deals out there for people shopping around for cash ISA rates, including interest rates on offer on cash from investment ISA providers. So definitely, as we always say, worth shopping around. And, it's not a huge surprise going in hand with that rate cut. We are now coming out of peak ISA season 2, so that peak new tax year. And competition was really, really hot for those cash ISAs coming up to tax year end and into the new tax year. Now, looking at the kind of 2-year longer fixed rates on cash ISAs, they're actually coming in 0.1% or so, or 0.1 percentage points or so, I should say, less than their 1-year counterparts. And that's kind of not unusual when the market's going to expect future cuts. But like I say, sentiment is split as to how fast they will come. Onto mortgages. So variable rates, perhaps no surprise, they were cut pretty soon after last week's announcements reported, across all the major lenders there. But those on the lookout for fixed rate deals might have noticed those rates aren't falling quite as fast as perhaps they'd hoped for if you kind of look at the news headlines. Now, that's because these products in that market uses what are known as swap rates to price these deals. And these haven't reacted quite as keenly to the base rate cut. Some good news, though, from the team at Money Facts Compare. I've been having a look at their analysis, and they've reported consistently that we're seeing more competition in the fixed rate space, which is really good news. And actually, that does mean that some deals are actually back to kind of the levels they were pre-mini budget. So if you think about somebody coming off a 2-year deal now, at the peak, maybe of the kind of the crisis, if you like, they should be in a better position than they were previously. So some good news for them. And also, the team found that the gap, or actually in some cases an inversion between the rates on offer for 5-year deals and 2-year deals, where 2-year deals were looking a lot more expensive, that gap looks to be closing, and maybe we are kind of trending back to, I don't want to say normal in that respect, but kind of things that people are perhaps more familiar with. So again, just like for savings with mortgages, shop around, have a look for those deals.
Yeah, I confess I keep watching interest rates like a hawk, market expectation, because I'm still on one of those ultra low fixed rates. I had a 5-year deal, comes to an end in December, and I'm just at a point now where I'm thinking, right, 6 months. Where's the 6 months? When can I start to lock it in, just in case everything goes crazy again? So just if you are interested in interest rates, or you've got people who are interested in buying a house, mortgages, interest rates, how they work, our sister podcast, Money Matters, Laura Suter and I are talking all about interest rates. We're going right back to basics. So if you've got sort of questions that you don't like to ask sometimes, do take a listen to that. You'll find it in the same place that you found this pod. But aside from tariffs and inflation, one thing that is playing into market expectation of where interest rates might go over the course of the year is the latest jobs figures. You mentioned them earlier. I think it's fair to say that there are certainly more signs that all is not well in the UK labour market. Look, immediately following the budget, and in fact in the run-up to the budget as well, with the expectation that employers' national insurance would go up, we had warning from business after business after business saying that it would impact their investment in jobs and potentially impact their ability to retain staff. Well, the last lot of employment figures actually take in the period just before those changes came in. So we're looking at up to March, the 3 months to March. Unemployment was up to 4.5%, a tiny jump, but still it went up. Pay growth slowed again by a tiny amount, but it went down to 5.6%. Vacancy numbers down again. They've been consecutively falling. Last time around, we got below pre-COVID levels. This time around, we're at 34,000 before pre-COVID levels. And I think it's really important that also the number of payrolled employees were down too, and the number of benefit claimants were up. So This is something that I think a lot of people are going to be paying really close attention to. How did those changes to labour costs, that national insurance, that increase the national living wage, obviously changes to the Employment Rights Bill, how are they all coming together and how will they impact decision making by businesses, but also the labour market going forward? And then, of course, potentially the interest rate decisions as well. It all sort of comes together, doesn't it, in one great big mass. And it was interesting because despite the fact that we've got people feeling a bit worried about tariffs, feeling a bit worried about the labour market, the sun's been out and they've been out spending.
We have indeed. I mean, the sun came out truly for Easter. It's still nice and sunny here as we're recording in Cheshire, and that has been reflected in the latest Barclays consumer spending data. So yeah, as the sun came out, so did our wallets. So a few kind of key points I picked out from that. So consumer card spending grew 4.5% year on year in April. That's the greatest jump they've seen since June 2003. No surprise, we've talked about the sun. It just makes us all feel a bit better, I think. But the sunny weather boosted both retail, hospitality, retail-wise, especially at garden centres. Danni, are you a fan of a garden centre?
I am. I'm a real fan of a garden centre. I keep looking at my garden furniture, which is now 20 years old, and looking a little worse for wear and thinking that's going to have to change. Yeah.
All right. Well, you didn't join them in April, but it sounds like it might be on the cards. So to speak, essential spending, that also returned to growth after 2 months of decline. That was up at 3.1%, tripping over my figures there. And I thought, actually looking at the release, it was really interesting that shoppers have started to prioritize British made products again, with 1 in 8 saying they were willing to pay a premium for UK based brands. So yeah, this is really felt through. So they actually said that they were reportedly happy to pay up to 22% more on average to buy British. So, Danny, is this filtered through to some of the kind of company reports that you've been looking at, some of the results that we've seen?
Yeah, it absolutely has. And I've picked 4 to take a look at. And I'm absolutely delighted that all 4 have done well. And all 4 are talking exactly about what you've just been talking about that sunshine effect. And I'm not going to go through all of them in terms of numbers, because if you are interested, you can take a look at Shares Magazine, and they did give sort of a full in-depth look at how they're doing. But I just thought I would start with, yeah, the sun's been out, and that might change your need for a holiday, because you might be thinking, well, it's sunny here, why bother? But people still want to travel. So we had On the Beach, and it's expecting a record summer. Holiday bookings currently 14% higher than at the same point a year ago. And that, of course, then has impacted the group's pre-tax profit, up 18% year on year in the period. You were just talking about getting out to garden centres, doing a bit of DIY. Well, we had Wickes Group. Its shares soared yesterday, Tuesday. We're recording this Wednesday because the DIY and trade home improvement business revealed a really strong start to the year. So turnover grew by 6.9% to 553 million between January and the 26th of April. This is just demonstrating that people are now getting back to buying houses, to making improvements, to feeling more confident, and to taking advantage of the weather, because you go outside, you sit in the garden, you look around and you think, yeah, that needs sorting. We also had pub group Marston's. It's returned to profit in recent months. It's cut costs, and it's really sort of pulled in people for those big occasions like Easter and Mother's Day. So it reported a pre-tax profit of 19 million for the 6 months to the 29th of March. That's from a loss of 200,000 the previous year. And that, is despite the fact that it's cut quite a lot of pubs. And again, it said that warm weather just tempted people out into a beer garden. You a fan of a beer garden, Charlene?
I am indeed. All beers, all gardens. Yeah, no,
You
it's crazy, isn't it? How it just sort of relaxes most people. And the sunshine, I mean, not the beer garden.
Yeah, no, absolutely. It does. And what people have been doing as well is they've been going out to a beer garden, they've been going out to their own gardens, they've been going out to garden centres, and they've also been doing it in a new wardrobe. So, Retail Bellwether Next. I mean, this is a company that just seems to get better and better and better, has an amazing knack. Not only for sort of defying gloom elsewhere on the high street, but also of sort of underselling expectation,
Yes.
under promising and over delivering. And once again, next sales rose 11.4% in the 13 weeks to April 26th. It took in £55 million, more than expected. And that has led, unusually, for Lord Wolfson to upgrade profit forecast by 14 million to get this 1.08 billion. I mean, that's significant, Charlene.
I mean, they're an absolute masterclass, aren't they, on expectation management, as you say. Like we always seem to talk about, oh, don't get too excited. And now you say an upgrade, a rare upgrade, and quite a hefty one at that. And I think it's kind of uncomfortable, but inescapable. Next is going to benefit with what's happening over at Marks and Spencer's. I mean, I already heard on the news about my data potentially being leaked. I had suspected it after all the systems went down, but I got that from the news before I heard from M&S themselves, which was a little bit disappointing.
Yeah, I mean, M&S have been very careful about the kind of engagement that they've had, what they put out. I mean, I was listening to someone that manages these kind of crises, and she was saying, "Well, look, there's absolutely no point in putting someone up from Marks and Spencer to talk to the media until they can give all the answers. Because if they come up and they say, we don't know yet. I'm sorry, I can't answer that. I just don't know what's happened with that. Oh, I don't know. We need to get back to you." That is just not good. So the fact that we did have this update from Chief Executive Stuart Makin, it was interesting because markets did rise slightly on the fact that there was an update, but then fell back as investors really started to process what was going on. Now, I had an email from Marks and Spencer. As you say, it came after that update to markets. But I think the tone has been really good. I think they've sought to reassure, and I do feel reassured. And I certainly think that they have been very good in the stores and online at really sort of managing this situation. And it's not their fault. They've been the victim of a crime. And I think a lot of people will give them quite a lot of leeway to try and get things back. But they're losing so much in terms of online sale. Next, absolutely, will be one of the beneficiaries. And you have to wonder how long online sales are going to be paused for, because, it's been more than 3 weeks. And I know that an attack like this, from listening to cybersecurity experts, is incredibly difficult to try and unravel and then put all those systems back together again. But yeah, I mean, I think when we get the next trading update from Marks and Spencer's, we're going to see very clearly in black and white the impact of this on their revenues. And also, we've seen the impact on its share price as well. Shares down 13% since that attack in April.
Thanks, Danny. Right, we promised you a packed show. Still lots to bring you. First up, if you've ever wanted to dive into the world of healthcare stocks, we've got a brilliant person on the show who's a fountain of knowledge on this topic. Emily Barnard is Deputy Portfolio Manager on the Edinburgh Investment Trust, which invests in some of the UK's biggest pharmaceutical names, along with a variety of other sectors. We're going to run Emily's interview across 2 episodes of the podcast because there's so much good stuff in it to get through. So next week, she'll be on to talk through the success of AstraZeneca and GSK in recent years and why they are some of the most interesting companies on the UK stock market. But for this week, Dan Coatsworth gets her thoughts about tariffs and the effect on the pharma sector, because there is a chance that we'll get an update on this area from Donald Trump in the next week or so. Or maybe we already have, depending on when you are listening to this pod. Also, it's worth pointing out we got details of the US president's moves on drug pricing, which came out earlier this week. But Emily explains things to think about when we get more details on tariffs and drug pricing and why there are specific risks for GSK. And she also talks about whether AstraZeneca and GSK and where they stand in the world of weight loss drugs.
I know that GSK and Astra obviously have a presence in the US. At the time of we're recording this, there's definitely signs that the Trump administration will, having not imposed tariffs on pharmaceutical products, sort of suggest that it will do. I know that both companies have sort of been talking about their exposure to this area recently, but is this a real risk to them, or is it just a case of they've already got manufacturing facilities in America, but obviously the active ingredients for their products some of it must be imported from other parts of the world into America, so they would be subject to tariffs if we had them.
Yeah, so you're right. At the time of recording, no tariffs yet. What's been commented on is that Trump intends to bring in or announce pharmaceutical tariffs in the next couple of weeks on drugs imported into the US. Let's wait and see if and when that arrives and what the details are. What both companies have said, they've both recently actually had trading updates. AstraZeneca have said that they adopt a sort of US for US strategy. So most of the drugs sold in the US are manufactured there. They do import a small amount from Europe, and they're introducing mitigating actions, and they've announced some more investment in the US, and they're looking to move some of that European manufacturing to the US so they can have a total US for US supply chain. And GSK has talked about, putting in mitigating actions, looking at productivity initiatives. What I think, and clearly not a risk that is unique to these two companies. What will make things slightly more nuanced for pharmaceuticals is, what price is the tariff being applied on? Is it being applied on the customs price? In the US, you've got a series of rebates that go on behind the scenes. So it's a pretty complicated healthcare system. So I guess we'll await details, and companies will await details and digest those and then can update the market. But actually, both of them, the advantage of being a large pharmaceutical company is you do have the supply chains where you can move things around, more flexibility than smaller companies. That's the latest updates they've given on tariffs. I think it's worth mentioning a couple of other points related to broader regulatory risk, which tariffs is part of. We've had various actually layoffs in the US at the FDA, the CDC, and we've had proposed budget cuts, National Institutes of Health, that research. It's quite a significant proposed budget cut. And I guess the question is, what does that do to speed of regulatory decisions? What does that do to speed of drug approvals? So it's generally adding a bit of friction into the system. Again, not unique to GSK and AstraZeneca, but certainly an issue for pharmaceutical companies. And the stance towards vaccines. So, the new health secretary and the recently, announced a couple of days ago, new head of vaccines, if you like, at the FDA, I think it's fair to say they wouldn't characterize themselves as being pro-vaccination. So, questions as to impact that might have, that's much more of a risk for GSK, as we've talked about, their strength in vaccines, particularly in growing the RSV vaccine in the US. That could be a shorter term headwind for sure. And then drug pricing, which is usually on the agenda of most governments. Now, again, the US system, quite opaque with these series of rebates behind the scenes. Something which the new administration has floated is whether they would look at what's called a most favored nation drug pricing policy. So this would be setting US drug prices to the lowest level paid by a set of reference countries, usually higher income reference countries. Again, that would be, quite complicated, quite difficult to work out at face value exactly what impacts would be. So regulatory risk for all pharmaceutical companies in the US is certainly higher now than it has been.
Yeah. Okay. Well, and just I think if someone is looking at the broader pharmaceutical space, a lot of excitement in the last few years about weight loss drugs. Eli Lilly, Novo Nordisk are the big players there. Surely the success they've had so far must have attracted other companies in the sector to think, okay, we want a slice of that pie, so to speak. Where does AstraZeneca and GSK fit into this? Are there any aspirations at all that they want to get involved in the weight loss sort of area?
So AstraZeneca, yes. They talked about this at their investor day last year, and it was, quite some interesting statistics that 50% of global population will be overweight or obese by 2035. It's a cost to economic growth. It's obviously a cost from a human perspective as well. So AstraZeneca have 3 assets under investigation in weight loss. And the main one is what's called an oral GLP-1, so an oral daily kind of weight loss drug. I think their one has the catchy title of AZD 5004. Yeah. Which doesn't quite roll off the tongue. They are looking at it as a standalone therapy and also as potential to combine with other molecules they sort of already have in the portfolio. What I think is quite interesting, and this is particularly for AstraZeneca, so they've got some real strength in cardiovascular, renal, metabolic disease. So one of their sort of workhorse drugs of the portfolio is something called Farxiga, which is used for heart disease, kidney disease, type 2 diabetes. And AstraZeneca have talked about, moving beyond shorter term weight loss targets and thinking about that sort of interconnectedness between obesity and cardiovascular and metabolic issues. So they've got a couple of assets under investigation. One's a little bit further along. And actually, I think they could have some really interesting options in other interconnected parts of the portfolio. For GSK, they don't intend, thus far, they don't intend on moving directly into the weight loss sector. But I think where there are opportunities for them are actually around inflammatory processes. So they've got a couple of drugs that are, doing decently for them around autoimmune, inflammatory processes. And what GSK have said is that they're thinking about what risks might persist or what other, associated risks there might be around obesity and where they sort of have exposure there. So AstraZeneca, yes, kind of look direct exposure in the pipeline, GSK more indirect.
That was Emily Barnard from the Edinburgh Investment Trust. I just want to stress that we recorded that before we got the news on drugs pricing from Donald Trump, but there's still an awful lot of questions there. Don't forget to hear next week's pod for the rest of Emily's interview, where she takes a broader look at Astra and GSK and why they have pride of place in the investment portfolio that she helps run. Right, Charlene, we spoke a little bit about mortgages earlier on in our chat about interest rates, but let's focus on one particular sector now, buy-to-let. What's going on?
Yeah, so landlords or ex-landlords, those leaving the sector, will be acutely aware of the rises to things like stamp duty for second homeowners, first introduced back in 2016, I believe, by George Osborne, and the end of tax relief to buy-to-let mortgage interest. Since then, we've also seen stamp duty surcharge go up to 5% as well. And this has all led to a slump in buy-to-let investments. And it's actually now gone back to the level it was in 2007, so before the global financial crisis.
It's a bit different in the north, though.
Yeah. So the Northeast in particular has bucked the trend completely and is actually the only area to have seen a rise in buy-to-let purchases in the last 10 years. It's now the most popular spot for investors, accounting for 25% of all purchases this year. And that was according to data from Hamptons. The slumps, though, they've been seen in London and across the south, the southwest and the southeast. And, if you look at the average buy-to-let purchase price, It's £150,000 in the North and the Midlands, and that's nearly half the £292,000 average in the South of England.
And prices and the housing market, just one of the reasons that kids keep coming home, even once they have properly flown the nest.
Yeah, there's a new buzz phrase. Well, it's new to me anyway. Boomerang kids. I mean, we love all these like Gen sayings, but yes, boomerang kids. So those coming back to live at home after having apparently left, sometimes even with partners and children in tow. Now, I'm not entirely sure how I feel about this. My little ones are only just at sort of junior prep school. Danni, you've got teenagers. Does this strike the fear into you?
Do you know it doesn't? I remember when I left university and I had no idea what I wanted to do, and I went back home for about 9 months before I went on to do a postgrad. And then again, once I'd done my postgrad and I was waiting to get a first job and I was doing lots of work experience, I was back home for another 6 months. So I liked having that cushion, and I'm hoping that my kids will do that as well. I'm trying to prevent my husband from taking over their room once they go off to university.
That's what happened to me. So, yeah, I think my I hadn't long left, and the old wallpaper stuff was out, trying to get it all off.
Before I let you stop talking, let's talk about something that you've been looking into. Because in the last budget, we saw the Chancellor up the rate of capital gains tax for higher rate taxpayers from 20 to 24%, which means more to pay. And that is potentially going to give HMRC something of a headache, Charlene.
Yes. So on the 30th of October, when Rachel Rees stood up, she hiked not only that higher rate of capital gains tax, main rate of capital gains tax, also the rate for basic rate taxpayers. That actually went up from 10 to 18%. So quite a jump for those potentially smaller shareholders as well. Now, it's classic, maybe left hand not talking to the right, but a mid-tax year rise like that, we have since found out, or we have since been told by HMRC, that their systems cannot cope with that. So this impacts people who have disposed is the official term, so sold or transferred investments, so like shares or investment funds that aren't wrapped up in an ISA or a SIP or pension wrapper after that budget date, after that increase on the 30th of October. If they've made gains above their tax-free allowance, so that's £3,000 for most individuals, this could lead to them running into a bit of a problem when they come to file their self-assessment. So CGT for the last tax year, the online assessment annual tax will be due on the 31st of January 2026, which sounds like a while away, but we're entering kind of what we would call statement season, where you will start to get statements from your investment providers about gains and disposals that you made in the previous tax year to help you complete that. So it's worth pointing this out as and when you're going to receive these statements. So it really impacts people who rely, which is over half of people filing actually self-assessment, who rely on HMRC's own systems. So they don't use perhaps the services of an accountant to do their self-assessment tax return, or they do it themselves, but they actually use commercial software. So you'd hope most accountants are going to be up to date on that. I'm absolutely sure they are. You'd hope most commercial software for filing returns is up to date. But, for over half of filers who use HMRC systems, that tax is going to potentially be underreported and therefore underpaid if you're relying on that HMRC system. So there is a little bit of a workaround. HMRC have launched a new calculator. So if you go, you can actually just Google HMRC CGT calculator. And what it does is you need to input a load of details on things like the gains that you made on or after the 30th of October, your taxable income, because that impacts whether you pay capital gains tax at the lower or the higher rate or a mixture of the two, along with any pension contributions or charity donations you made for gift aid. You input all of this data into the adjustment calculator and it will come out with a figure that you need to input on a special box on your tax return. Now, I think off the top of my head, it's box 51. Really sad that I know that, but it's the boxes that go along with your capital gains tax figures, and it's known as an adjustment figure. Now, most people would never had to use this adjustment figure box or come across it before, but it is there and it'll be very important for this tax year. So I've written a little update for our customers that will be going on our website and sent out to people subscribed to email shortly. But it's definitely worth bearing in mind as you start to get these statements. If you do have holdings that you sold in accounts like your dealing account or general investment accounts with other providers, keep a keen eye on this because, as we know, you do not want to underreport and underpay that tax because then you'll start trickling into fine and penalty space as well.
Thank you, Charlene. Right, let's round off this pod with a chat about an investing legend. Last week, Dan was talking about the news that Warren Buffett sprung, something of a surprise, at the recent Berkshire Hathaway annual shareholder meeting, announcing plans to step down as CEO by the end of the year and hand over the reins to Greg Abel. Tom Sieber from Shares Magazine is with us. Tom, I know Shares been talking to fund managers which hold Berkshire about the decision and what it means. What have they said? Now let's round off this pod with a chat about an investing legend. Last week, Dan was talking about the news that Warren Buffett sprung something of a surprise at the recent Berkshire Hathaway annual shareholder meeting by announcing plans to step down as CEO by the end of the year and hand over the reins to Greg Abel. Tom Sieber from Shares Magazine is with us. Tom, I know Shares been talking to fund managers which hold Berkshire about the decision and what it means. What have they said?
Yeah, thanks, Danny. Obviously, when a 94-year-old announces retirement plans, it can hardly be considered as a great shock. But at the same time, I think Buffett's been part of the financial market firmament for so long that the news did catch some people off guard. We actually looked at the issue of the succession at Berkshire Hathaway at the start of last year in the magazine, and we thought it'd be interesting to go back to some of the fund managers we spoke to then and get their views on what's been announced just recently. So one person we heard from this time round was Keith Ashworth-Lord, who appropriately enough runs a fund which is literally called the Buffettology Fund, and Berkshire Hathaway is one of its largest holdings as well. And he noted that the succession had been in the works for a long time and that the intention was that this was a business which would be built to outlast its architects, as he put it. He thinks Abel will be a good operations man. He's earned quite a reputation as a hard taskmaster in his existing role. And he noted as well that Warren Buffett's son, Howard, will look to maintain the culture when his father eventually steps away from the chair seat. So that's something that's not happening immediately, despite him exiting as CEO. Another person we spoke to, Nick Brind, who is lead manager at Polar Capital Global Financials, also a shareholder in Berkshire, thinks the change will actually be pretty limited, as Buffett handed over some of the day-to-day running of Berkshire to Abel a few years back. So in his words, he said everything has changed, but yet nothing has changed. He does expect the annual shareholder meeting in Omaha to become a bit of a quieter affair, and I think a lot of people will miss the kind of regular pearls of wisdom from Buffett that he used to deliver. What I always think is a bit of a ludicrous description, but is sometimes called the Woodstock for capitalists. So.
Yeah, I must admit, I've heard that before, and I think you're absolutely right. It's going to be a very strange event, particularly if Buffett doesn't turn up, because I imagine he might still turn up.
He may
For
well,
at least
yeah,
the first
certainly
one.
next year. Yeah, that's true.
So what, if any, are the key concerns, and what do they see as the key issues facing Buffett's successor?
Yeah, so the first thing to say is there doesn't seem to be any huge concern at the moment. So Ashworth-Lord says as long as the performance remains strong, then the somewhat sort of quirky nature of Berkshire, it's obviously a bit of an outlier compared with other listed companies. You know, it has this investment side, but it owns stakes in lots and lots of US businesses as well. And it has this insurance business. So he thinks they'll retain the support of the shareholder base. He notes that the responsibility for the investment side of the business is now passing to Todd Combs and Ted Weschler, both of whom he feels are well proven in this task, while Bridget Jane is going to remain in overall charge of the insurance operations. But I think really the key question is what Berkshire does with its huge cash pile. And Brind at Polar Capital acknowledged that. You know, he said, along with the fact the sheer size of Berkshire, so it's got upwards of $1.1 trillion in assets, makes it difficult to find opportunities to deploy cash in a way that, as he would put it, would move the needle. He also adds that it's sitting on $350 billion in cash and treasury bills, and that's a record as a percentage of its assets. And, I think the key question for Abel is, what happens with that cash, and when and where do they deploy it? And, I think that's a challenge, but I guess it's also an opportunity. And Bryn points out it's a huge strategic advantage for, as he puts it, when the tide next goes out, or in other words, when there is another market correction.
Yeah, I think we've been waiting to see what Berkshire Hathaway does with that cash for a while, so it'll be interesting to see what happens next. Thank you, Tom. That is about all that we have time for from this week's pod. It's been a packed one, but before we go, just a reminder that Charlene hosted a webinar on Tuesday evening all about combining pensions. You can watch that back via the investment videos on the AJ Bell website. Charlene, you got a lot of questions.
Yes, I did. I mean, I absolutely love it, obviously, but I had over 100 questions sent in before by people who'd signed up to watch, and actually during my presentation. Now, I love talking pensions, like I say, but that would have been too much to cover even for me, and I think everyone would have turned off quickly. So what I'm going to do is I'm going to round up those 100 plus questions. I think it's 127 at last count, and look at the common question themes. And when I'm back in the hosting hot seat in a couple of weeks, I will go through these. I'm not going to be able to provide an individual answer to everybody, obviously, and I can't give advice, but I will be going through the common themes and hopefully giving you the answers you need. Now, if you are subscribed to our email updates as well, we've got a special edition coming your way on all things combining pensions, and where you can make some, potentially huge cost savings. And that's coming in after the bank holiday too. It's also going to have a little look, as we like to be a bit nosy on the program, and find out how much people have actually located using our free pension finding tool. So if you want to get that update, just make sure you've got the content email box ticked in your preferences, and you will find that winging the way to your inbox.
Oh, I love being nosy. I love that kind of
like that.
data. Yeah. Thank you, Charlene. And remember, do keep your questions coming in about any topic, pensions, whatever. We do love to hear from you. You can either leave a comment wherever you listen to your podcasts, or drop us an email. That's podcast@ajbell.co.uk. Next week, as we say, you can hear the second part of Dan's interview with Emily Barnard from Edinburgh Investment Trust about investing in big pharma. And Dan and Tom will both be back to discuss the latest UK inflation data, which comes out next week, along with any other markets and personal finance news.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.